Hello and welcome to Fidelity Connects. I'm Pamela Ritchie. North American equity markets wobbling a bit today. This is as consumer confidence continues to find its footing. We have some new data out. Concerns about tariffs and inflation, coupled with last week's batch of weak economic data, is raising some warning flags about U.S. growth prospects. Now, despite some of the current market challenges, our next guest feels confident in his positioning and even sees today's opportunity for Canadian equities, some of the opportunities for later in the year for Canadian equities. Joining us here today to talk about how he's navigating through today's markets and the North American equity market landscape is Portfolio Manager Darren Lekkerkerker. Darren, welcome back. Great to see you.
I'm happy to be here. Thank you.
Delighted to have you here and to go through the fund a little bit that you're managing. I got to ask you about these markets. So it's been a wobble. Sometimes portfolio managers think, great opportunity when there's a market wobble. But what do you make of all this? Because some people are a bit nervous.
I think you're right. I look at it as an opportunity. First off, we had a really, let's put it in context. We had a really strong start to the year, and now we are having a little bit of a pullback. There are a few narratives as to why that is. I don't think any of them are anything to be, really too overly concerned about. I think instead my approach is to think, hey, stocks are the best asset class in the long term. In the short term, they are volatile. That's maybe the cost of getting that good long-term return. So, my approach is to own a portfolio of high-quality companies, and I just think, look, the economy over time is going to grow. Earnings power is going to grow. I'm trying to own better companies that can grow their earnings power more than the market, and I think that'll drive returns for the portfolio. And just coming back to what you said, I do think it's an opportunity, and I think for investors, you need to not panic, look at it as an opportunity. And for myself, I'm trying to find the baby that's being thrown out with the bathwater on days like today. Okay,
really interesting. And so that's what you're trying to perhaps look for today and how that works. Just remind us, like a quality company, in a market sell-off isn't necessarily not going to sell off to a certain extent, but just sort of remind us of the pieces of why it holds water better.
Yeah, you're right. I think that they will go up and down on days like today, but I think in the long term, I would hope that they would go up more. Why is that? I think they're strong companies. They've got strong underlying demand for their products or services, a good balance sheet, which doesn't amplify risk or demand, and then stronger margins and free cash flow. I think high free growth in free cash flow per share is what drives stock prices over time, and I think that these companies have it.
Right. Okay. Well, let's go into some of the
Sure.
the companies themselves, or at least the sectors ultimately. What are some of the secular themes that you're with? We talk endlessly about AI. There is that, but you're looking mostly at companies that fit into doing what? What are the areas of the market that you find of interest right now? I never earned you the multiple Lipper Awards I've noticed over the last few years. Where are you looking?
I appreciate you bringing that up. It
feels
great on a day like today when the market's down. So I think for me, I'm really looking very broadly across the market. I don't like to be too associated with one theme, because then if you get the theme wrong, then it can really impact your portfolio's performance. Instead, I have more of a bottom-up individual company focus. One sector that maybe is not as well talked about on this podcast is aerospace, and that's one that really benefited this fund last year. I had two companies in aerospace where they make both parts that go into airplanes as well as services, the aftermarket services. And so why do I like this space? I think number one, there's long-term secular demand growth for air travel as the population grows and as people get wealthier. Two, airplane manufacturing. There's two large OEMs in the world, Airbus and Boeing, and they're
behind, right? So behind.
Yeah, exactly. They got so behind during COVID. Then there's been safety, regulatory issues that have made them more behind. Then they also had very big strikes at Boeing, and so I think the fact that they're behind and they have these big backlogs, there's going to be growth for several years. So I think that we're still in a good part of the cycle. There's there's everything I look for in a high quality company here. There's secular demand. There's they kind of have their little monopolies on making parts because the parts have to be approved. So they have very high margins. And then in the aftermarket where they're producing that part or servicing. And so that's very sticky revenue growth.
Okay, really, really interesting. And Within Canada, let's go to sort of the U.S.-Canada mix. You're looking at North America. This is your hunting ground. Are you looking at aerospace in Canada as well as the U.S.?
Yes, I am. And so that's probably going to lead us into another thematic, which is I think that Canadian aerospace names are very exposed to potential tariffs. And so like that's probably something else that's on people's minds. So in terms of tariffs, why don't we just cover that off since we're here? And so I think with tariffs, look, there's a lot of headlines coming out. Some people may be sick of talking about it. I think that once we get a definitive resolution, whether it is a negative, whether it's a renegotiated free trade agreement or it is a tariff, I think that'll just be a positive to have a certainty in the business environment. I think on the sell-offs, I am looking for companies that are being sold off too hard versus what the potential outcome may be, and would prefer to lean in and look at it as an opportunity. And without getting too much into politics, the other thing on Canada is that like Canada has underperformed. I do think that, look, there's going to be a federal election. We will get a new leader, whoever the leader is. I think there will be more of a pro-business agenda, pro-economic growth agenda, which I think will be very positive for stocks.
Right. Okay. Really interesting. Let's go back to sort of the exposure to tariffs, because it's interesting for how you find opportunities. Those that you hold in the portfolio, you've obviously done the how exposed,
right.
So how exposed are you within the portfolio to Canadian tariffs?
Very little direct exposure, and direct I mean companies that are like exporting into the U.S. Or even U.S. companies that are importing from China or Canada. Or exporting abroad. So very little direct exposure, but I think that there is a lot of indirect exposure, which is like if you do have very significant tariffs, what that impact will be for the economy. I don't think that will happen. Like I do think that the Trump administration really cares about economic growth and the stock market as a measure to reflect their performance. So I don't think that will happen. I think it is more negotiating. I do think we will get some tariffs, and I'm waiting to see what that is.
Okay. But as you say, the certainty of it should allow for, a lift. We said this sort of in the intro. Go into that a little bit. There would be a relief rally, basically?
I think so, right? I think that like in the stock market, like uncertainty is like the worst. And once you actually have certainty, I think that can be better. I think that like clearly there is something discounted in the markets for what tariffs could be. And so I think if we, depends what it is, right? If it's the worst case scenario is clearly not, but you also have to think what's the second order impacts. Like it's not just that. I think the Bank of Canada would lower rates. I think there would be fiscal stimulus. Right. I think there would be other
valves.
Yes.
So it's interesting in the markets right now. We're seeing this sell-off. It's providing perhaps opportunities, but there was, a so-called Trump trade ultimately that was largely fueled by, lots of things, but the deregulation piece of it was a big one. The thought that there would just be a less regulated U.S. companies and so on. Speak about that a little bit, the trade itself, and also deregulation in Canada. So maybe we just start with the deregulation trade has meant great things for financials and so on. Do you think we'll see that in Canada as well?
Maybe. I do think that it's hard for a country and its regulators to be out of step with their global rivals, especially for industries that are global. And so I think you mentioned the banks, and I think that certainly in the U.S., financials did benefit from a Trump bump post the election. And I think that's probably has to be taken into account by OSFI and the Canadian bank regulators in terms of the amount of bank capital and other important regulations. And I think that generally, like lower capital requirements are better for shareholders because it just means more money for banks to organically grow or return cash flow to us as shareholders. And I think just the first part of your question, we had a Trump bump in the stock market, and I think people got excited about lower taxes, about deregulation, about an American first agenda, more growth in the U.S., reshoring of manufacturing. And I think since then, people have kind of become a little more concerned about some of the negative economic aspects of the new Trump administration, the tariffs. What is the impact of DOGE on the economy? What is the impact of lower immigration on the economy? Things like that.
Right, and so that sort of is coming to the fore now, perhaps in the markets. It's hard to know exactly what it is, but so that's interesting. What areas have been mainstays for a while in terms of either themes, secular? I remember a while ago we spoke to you about kind of architecture firms, engineering firms. there's a build out, and there was under the Biden administration, it was a particular type, but you see this going forward as well?
Yeah, so it's the engineering and design firms.
Okay.
And so I still really like that subsector, that industry. I think that there is really nice organic growth going forward. They're capital light, meaning like it's really the assets are people, it's engineers, and it's not like machinery and equipment. So because it's capital light, you have high margins, high free cash flow. There's also really nice, they're able to like sort of buy like smaller mom and pop type of company. So I like that thematic when a company generates a lot of cash flow and they can buy smaller and cheaper private companies in the same industry and use their scale to benefit their margins and benefit from buying them at a lower multiple. So I really like that. I think with the specific companies that I own, there's individual theses in terms of like transformation and improvement going on with the company. Whereas they can sell non-core assets and get out of businesses that people don't like, and also use their strong balance sheet to redeploy capital accretively, as we kind of discussed.
Yeah, really interesting. Digging further into sort of the industrials and that side of things, it's been a really interesting sector because it seems like industrials and are changing a bit what they mean, and I guess what they're focused on in terms of building economies and powering economies. There's been a lot of discussion on AI and the powering of it. Is that an area that you're in particularly?
It's an area I'm interested in, but it's not an area that that I have much ownership exposure to in the portfolio. I think I don't really own data centers or the companies levered to the electrification power theme.
Okay. And what about the Mag 7? Is that an area? There's a big valuation discussion going on in the markets right now, whether they've overinvested in AI or not, or maybe they haven't. Is that an area that you're invested in?
It is an area I'm invested in, and I when I look at the Mag 7, I really do think that although they've done very, very well as a group, I do think you need to differentiate. And I think recently we're seeing more differentiated performance between the stocks. I think like people think of the group as very expensive. Some stocks are very expensive. Some stocks are like, for example, Google, Alphabet is cheaper than the market, right? And whereas Tesla would be very expensive. So I do think you need to differentiate not only on valuation, but also on like demand drivers and capex and things like that.
Fascinating. Areas like transportation, is that of interest at this point?
Transportation is an area that I've been very cautious on in the North American portfolio. I don't think I have any. There's
a cyclical story there.
Direct exposure. It's something that I'm watching very carefully, and I think we've been in a freight recession since 2021. So it's been a few years, and I think that eventually it should rebound. But it's one that I'm being a little cautious on, and partly just I'm seeing opportunities in other areas within industrials. Like we talked about aerospace, we talked about engineering and design. Another area that I look a lot at there is information services, or even more broadly, commercial services, where it's like B2B, business to business transactions. And so some of the areas I've looked at are like auction companies for industrial equipment or salvaged automobiles, as well as like waste management companies and companies that sell business software, like legal software or accounting software, where they're able to actually deploy generative AI and increase revenue.
And consolidate to an extent. Are they consolidators as well?
Yes, yes. Although that's more of an organic growth story. I think where you're going with that one is in terms of software. Yeah. One of my top 10 positions that we've spoken about before is Constellation Software.
Yeah, I wanted you to say it, not me.
I like the software consolidation model. And so for them, they stick in a specific niche. It's vertical market software. They've been really great in this niche at acquiring companies very cheaply. They've grown at double-digit rates, both top and bottom line, and done so with a minimal amount of debt for a long time.
Are you seeing, Darren, any sectors benefiting from the recent increase in Canadians buying Canadian?
That's a great question. I think that
I'm just doing it at the grocery store level, but
I think that trend's pretty early right now. So it's something we're still to watch, but it's not something that I'm focused on or own in the portfolio.
So let's go to the mix between U.S. and Canada, thinking that perhaps there might be some nice opportunities to take a look at Canada later in the year. That said, most of the portfolio is U.S. companies. Is that right? Just tell us about the breakdown.
That's right. It's about 75 U.S., 25 Canadian.
Okay. And And the currency is to what extent a question mark for you? I mean, the Canadian currency's had a truly rough go lately, and maybe could get worse. We don't know. Do you spend a lot of time on that?
Not really, but
No.
having said that, I do think about it a little bit. I have favored the U.S. dollar. I mean, I think like one, you can see that growth is better there. Two, we can see that interest rate differentials have been much better. By that, I just mean that the Fed hasn't lowered rates nearly as much as the Bank of Canada. So that's supported the U.S. dollar, and I think a lot of the Trump policies have been more U.S. dollar positive.
Right, for sure. Yeah, it's interesting how some of that may change ultimately, but we'll sort of have to wait on that. In this moment of uncertainty, just remind investors, what it is you're doing to kind of plow through this. Is it a case of no sudden moves?
Yeah, no, I don't think that I want to make big changes to my portfolio as we go through a downturn. Instead, I'm really just looking for high quality companies, either that I own or don't own, that I've sold off a lot that I want to add to. So it's really just that, and it's really just continuing with the same investment process that's generated good long-term results. And so what are we doing? We're focused on like meeting with companies. So companies are coming in. They're in right now upstairs. I work in this building, and we're doing update calls. So we generally like listen to the public conference call, and then we have an update call right after, or with words with maybe the CFO or investor relations person or CEO, if we're lucky, of the company. So just continue with the same process.
There's lots of reporting going on right now. Some of it in the financial sector.
Right.
Yeah, it's been an interesting time, and we talked about regulations, so maybe we've kind of covered off that a little bit. What are CEOs saying about tariffs? You get the feeling that a lot of CEOs are trying not to say very much, actually, at this stage, just because they don't know either.
They don't know.
Yeah.
I think they don't know, and they're just trying to make sure that they've appropriately planned for it.
Yeah.
And so I think that question comes up on both sides of the border. I was recently in the U.S. for an industrials conference last week, and came up in all those meetings too, but they don't really know. I think instead they just try to think like, what's their competitive position if it does happen? How would they manage the worst case? How would they change their supply chain? Do they have the pricing power to price for it? Things like that.
Right. And for Canadian companies, it would have a competitor in the U.S.
Right.
It seems like that's one of the sort of risks of exposure, isn't it? That if there are competitors in the U.S. and they're not being hit with tariffs, it's a different calculation for an American buyer.
Sure.
Is there sort of an upside story for U.S. companies on that?
On the tariffs, I think that there is. There's some areas of the economy that are protected. For example, steel, which may see a price benefit. Right. I think there's other areas, for example, off-price retail that could potentially benefit due to a lot of pull forward of orders of department stores and having excess inventory, things like that. So there's a couple of companies that can benefit. Normally, it's in the first category where products are protected and they have a foreign competitor.
Right. Okay. Really interesting. You've often said there are always problems in the world, and you just kind of invest through it. This does seem like closer to a watershed moment in sort of the global economy, at least the questions they're grappling with. Maybe it'll all turn out to be nothing, but it does seem bigger than those other times. Again, you seem very calm about everything and not too flapped about it, unflappable.
Thank you.
Maybe I don't know if you are or you aren't, but this does feel like a bit of a moment. So what do you have to say to investors like who want to, I don't know, either act or not act?
I don't think there's anything really consequential going on. I mean, I guess the tariffs, but I do think that, like, my opinion on that is that it will not turn out to be as bad as the first offer, so to speak. It seems like everything's a transaction. But I think it's something we're going to get through, and I think just generally the economy is going to grow. Companies that I own are levered to that economy. They're going to grow their earnings power, and I think the stocks will follow earnings over time. And it's our job to, in this portfolio, it's my job to select the best companies.
And okay, really interesting. Select the best companies that will continue to go further. The volatility in the markets right now, again, I just sort of want to have you point to either where it's coming from or tell us a little bit about what might be of interest to you that's selling off. I'm kind of getting at, like, are there value companies? Are there smaller cap companies? Are there the areas where you might see rotation after such a long time of dominance by a Mag 7 and a few small companies in the equity markets.
I think there's a lot of opportunities, and I think there's opportunities across sectors. I kind of find that I like what I own, and I'm pretty happy for it. And for companies where I own it, if I don't have if I don't have high conviction, then maybe I shouldn't own it. And if I have super high conviction and it's going lower, then maybe I want to own more of it. And that's how I tend to think.
Okay, so there aren't a lot of companies out there that you haven't been closely watching, if not already invested in, that you're suddenly going to pivot towards.
I think there's not a lot of changes in the portfolio. We're still coming through earnings. Earnings season has been pretty good, mind you. I think generally earnings have been very strong across most sectors. So
fantastic. What do you think about? We won't again go too deep into leadership in this country, but mostly on the regulatory front, which we've seen in the U.S. give a massive bump to their equity markets. What sort of regulations could be peeled back here a little bit? I mean, probably financial. You mentioned that OFSI needs to take a bit of a look at it. Are there others that would aid in various industries across this country that would make something interesting to you?
I think regulatory change is very slow. I think what's quicker is the change of people. I think people are policy. And I think what could happen, especially if we have a leadership change in this country, something like we saw in the US where the people were changed or replaced, and I think that's what could see a faster change than actual policy change.
Okay, in terms of how it does for stocks or companies and so on.
And companies, industries, companies, yes.
That in which areas of the economy, though?
I'm not sure in Canada, so I generally
think
that
are oil and resources here, but this is an area
I don't think it'll have the same degree of flip that we saw in the U.S. So I think in the U.S. We saw in terms of like M&A, it was almost impossible. I had lunch with the CEO of one of the 2 or 3 largest banks in the world. There's like not just me, there's like 10 people at the lunch a few days before the election. He said like no client will do a deal above $3 billion because, or very few will. They have to be prepared to sue the government and have their deal hung for 18 months. And I think now you've had a change in personnel and a change in policy. So I think we could see a little bit of that. But I think in Canada doesn't seem to be quite as
hard in such moments. You have been running a portfolio of natural resources, taking a look. This is an area that you've been with for a long, long time. The commodity sector, where does it go from here? This is really sort of the regulation question.
Yeah, right. So I think with commodities, one of my smart friends in commodities says, with commodities you gotta be able to dream the dream. And so if you want to own, if you want to own a commodity stock, like you have to think that commodity could go up a lot. And
the global price.
Right, yeah, the spot price of that commodity. And so I think what that means is, I think gold, people are excited about gold. I think gold has been doing very well on central bank purchases, central banks diversifying away from the US dollar into gold. And I think that, maybe gold could do well. It's one that I have a hard time forecasting in my mind, but it was up a lot last year. It's had a very nice start up to this year. I think copper is easier for me to analyze. It has favorable demand supply characteristics for the next few years on the demand side, as well as supply is extremely challenged. I think oil, on the other hand, probably looks a little softer, where I think there is a lot of supply. OPEC does have a lot of spare capacity, and I probably have much less exposure in my portfolios that I manage to energy directly because of that. I also think in the natural resource fund, I think there's a lot of under the radar, like high quality, really good companies and materials that people think of. Maybe they think of them more as industrial companies than materials companies.
Why would they think that? Yeah.
Because I think when you think of materials, you think of mining and metals, and you may not think of like coatings, which is paint companies. And coatings, why are they great? Because you can raise the price every year. And you have tremendous margins in free cash flow. And I think that's really attractive. Aggregates, right? Like it's like the gravel to build a road. It's the
that what aggregates is? So it's building materials.
Yeah, it's building materials, right? And so like it has such good characteristics, like 2% of the cost of like every building or road or whatever. So it's inconsequential to the overall cost, but you absolutely need it. So and it's a local monopoly because it's low weight to value, so you can't rail it from far away.
Right.
So these are a lot of the types of companies that I look at
like rocks to build a road.
Yes.
Yeah.
Well, it's great when the price never goes down. Last year, the price was up quite a lot. So
that's fascinating. So are there any sectors, we kind of talked about the commodity sectors within, that you feel are currently oversold?
Yeah, I mean, I think on a sector level, I'm not certain. There, look, this sell-off, we're like, I think it's like day 4 or day 5 into it, so it's still pretty early, and it's something that I'm watching. So,
Not yet.
I think just generally, I like what I own, and I think that look, I think that some tech stocks have been hit very hard, and there's some opportunities there. I think that within financials, there's been a sell-off. I think the fundamentals are really strong within financials. That's another area that I'm looking at. I think in more so in the U.S. I think in the Canadian ones haven't sold off as much. Maybe it's been more moderate, and it's kind of mixed this morning with banks reporting in Canada. I think also on the consumer side, I'm a little cautious on consumer goods type companies. Kind of prefer to play it more through consumer services, but which I think consumer services benefit because they tend to be more purchased by sort of the higher end people, the sort of higher income earners in the economy, which tend to be benefiting lately in the economy.
Are you talking about consumer discretionary or
consumer discretionary?
Yeah, really interesting because a lot of those have come off low levels. Okay, just a final thought that you want to leave with everyone about your portfolio. I think it's just about 10 years old. You've been running this fund for just about 10 years. Massive year last year. Congrats.
Yeah, thank you.
Where do you go from here?
Higher, I hope. So thanks very much. So I started running the portfolio at the end of October in 2015. So this year will be its 10-year anniversary. The fund's done really well in terms of absolute performance. It's generally been fairly consistent. So what do I hope to achieve? I hope to achieve continued good absolute performance and relative to the benchmark. And that's my goal. And also for those that don't know, I'm the #1 retail shareholder of the fund, and it's very significant to me personally as well.
Yeah, that's always great to hear that people own their own fund. Darren Lekkerkerker, a pleasure to see you. Thank you for joining us, and we'll see you soon.
Thank you very much. It's been great.
Thanks for listening to the Fidelity Connects podcast. Now, if you haven't done so already, please subscribe to Fidelity Connects on your podcast platform of choice. And if you like what you're hearing, leave a review or a 5-star rating. Fidelity mutual funds and ETFs are available by working with a financial advisor or through an online brokerage account. Visit fidelity.ca/howtobuy for more information. On fidelity.ca, you can also find more information on future live webcasts. And don't forget to follow Fidelity Canada on X. The views and opinions expressed on this podcast are those of the participants and do not necessarily reflect those of Fidelity Investments Canada ULC or its affiliates. This podcast is for informational purposes only and should not be construed as investment, tax, or legal advice. It is not an offer to sell or buy, or an endorsement, recommendation, or sponsorship of any entity or security cited. Read a fund's prospectus before investing. Funds are not guaranteed. Their values change frequently, and past performance may not be repeated. Fees, expenses, and commissions are all associated with fund investments. Thanks for tuning in. We'll see you next time.